Most people believe this. If I made more money, I'd finally stop stressing about money. And it sounds reasonable. Higher income should mean fewer problems. But here's the puzzle. Across multiple national surveys, millions of people with steady jobs and even high incomes still report intense financial stress. So today, we're answering a simple but uncomfortable question. Why doesn't more income reliably reduce financial stress? This isn't about bad budgeting or lack of discipline. It's about how financial stress actually works and why income alone often misses the point. To understand this, we need to separate earning more from feeling financially secure. The Consumer Financial Protection Bureau defines financial well-being not by income, but by financial security and freedom of choice, the ability to absorb shocks, meet obligations, and stay on track toward goals. In other words, you can earn more and still feel financially trapped. Let's walk through the data that explains why. First, financial stress is about security and control, not income. The CFPB explicitly notes that people can experience poor financial well-being at any income level. That's because stress comes from uncertainty. Can you handle a surprise expense? Do you control your money, or do fixed bills control you? Is your income predictable enough to plan? If a raise doesn't improve those answers, stress often stays the same. Second, many working adults still can't absorb small shocks. The Federal Reserve tracks emergency resilience in its survey of household economics and decision-making. Year after year, the results are consistent. A meaningful share of adults say they could not cover a $400 emergency with cash or savings. And these are not only unemployed households. Many are working full-time. That matters because if one car repair or medical bill can trigger debt, the nervous system stays on high alert, regardless of salary. Third, raises often turn into fixed costs. As income rises, many households convert that extra money into permanent obligations, higher rent or mortgages, childcare, car payments, insurance, and subscriptions. Research from Bankrate and analysis from the Bank of America Institute show the same pattern. Necessity spending consumes a large share of income, leaving very little slack. Stress is driven by margin, income minus fixed commitments, not income alone. If your margin stays thin, stress stays high. Fourth, even high earners report paycheck-to-paycheck stress. This surprises people. Economic research reviews and large consumer surveys consistently find that a substantial share of households earning over six figures still describe themselves as paycheck to paycheck. This doesn't mean high income causes stress. It means high obligations can absorb high income. Used responsibly, this data illustrates a simple point. Income does not immunize you against financial fragility. Fifth, money reduces stress mainly through buffers and predictability. The Federal Reserve consistently emphasizes emergency savings as the primary buffer against income volatility and unexpected expenses. And the CFPB frames financial well-being around shock absorption, predictability, and being on track, not just getting by. A volatile income, or a raise that never turns into savings, does very little to reduce stress. Money helps most when it creates stability, not just spending power. Sixth, psychology helps explain the gap. Research by Daniel Kahneman and Angus Deaton famously distinguished between life evaluation and day-to-day emotional well-being, showing that income relates differently to each. More recent work by Matthew Killingsworth finds experienced well-being can continue to rise with income, but not automatically, and not evenly across people. The takeaway isn't that money doesn't help. It's that money doesn't remove stress unless it reduces uncertainty and exposure to shocks. Finally, financial stress is widespread and persistent. The American Psychological Association has repeatedly ranked money as one of the top sources of stress in the United States. This is not a niche issue. It's not a personal failure. It's a structural problem in a system where income growth often arrives alongside rising obligations and instability. So here's the grounded conclusion. Income helps, but financial stress is driven by margin, buffers, and predictability, not a number on a paycheck. If higher income doesn't create slack or stability, stress doesn't fall much. Understanding that changes how you evaluate progress and how you plan for peace of mind.